Joining us now is 3Fourteen Research co-founder Warren Pies. Warren, I want to get your take on this because you had turned bearish on crude before we saw this move lower. What did you see then that changed your mind, and how is it playing out now?
Yeah, thank you for having me. Just to review, we were long from early summer, like early July-ish, through mid to late September. And really what we've been playing this entire year in the crude oil market is the speculators, fading the speculators within the futures market. So hedge funds get really short and you want to take the other side of that trade. And when hedge funds get really long, you want to take the other side of that trade. And so at the summertime, you had hedge funds betting on recession, and then they've all kind of come around to our view. Triple digit oil was kind of something all the banks were talking about, and it became consensus. Then we had the Middle East crisis with Hamas invading Israel, and that kind of gave another boost to the speculators. And by the time we got into late September, the whole situation had reversed itself. And we'd gone from a situation where hedge funds and speculators were really short the oil market to long. And so I think we're in the process now of working off that excess sentiment. And it's really, there's a lot going on, as always, in the oil market. That would be the main thing going on right now, in my estimation. So
this is really more about trading behaviors and the technicals, and it's less about the fundamentals. Because that was my next question for you, especially given the fact that data has been pretty mixed, economic data, is how much of this was being driven, this move lower in crude is being driven by economic uncertainty and worries about demand versus, to your point, geopolitical risks and worries about production?
Yeah, I think that it's hard always to disentangle that. You know, in the oil market, we like to say inventories are kind of the scoreboard for oil fundamentals, because it's the nexus of supply and demand, and that's where that nets out. If I had to guess, like our studies show, we went back all the way to 1987, every single kind of major crisis event in the Middle East. And what happens? Usually you get oil, we bid it up. Everyone's worried. No one wants to be short oil going into a geopolitical crisis. And so that's the behavior around the first month of a crisis. And then as long as we're not directly impacting oil production, say Russia, Ukraine, for instance, or the Iraq war series, outside of those, you basically give those gains back. And I think that's what we're in the process of doing. If you want to get really technical, I think November it's really the seasonally the weakest part of the year for crude oil. It's coming right on the heels of Mexico hedging all of their crude oil production. It makes banks and dealers really skittish. For technical reasons, they have to sell futures into any weakness. We call that negative gamma in the crude oil market. And so these things have all kind of come together seasonally into November. We have an OPEC meeting at the end of this month. I don't expect them to do anything more, but they are going to probably jawbone and try and, talk the market back into better balance. And so net, I think it's really just an adjustment of positions, and everybody wants to explain after the fact what's going on.
So if you're not invested in oil, at least not right now, where are you putting money to work? What is exciting you right now?
We're overweight fixed income after a long time of avoiding the space. And so this is where we've added some duration back on. And we did that on October 19th when the 10-year hit 5%. I still like that. I mean, we've had a huge rally in rates. We've had, we've gone down to 4.5. And I think that's kind of the bottom end of fair value on the 10-year. And so it's less attractive here, but that's still probably my preferred area. And the thing that makes the current environment so difficult is I think that it's kind of all one big trade right now. Equities are taking their cue from the rates market, and the rates market's ultimately looking back at the Treasury and the funding and all the stuff that's been going on for the last week. And how is the Treasury going to fill this record hole that they have going forward next year? We estimate $2.5 trillion funding hole. I think 5%, 4.5% to 5% on the long bond, though, is enough where you're going to start getting some flows, and those bonds start looking more attractive.